G'day everyone, welcome to this week's live Q&A. Ask Alan, great to see you, thanks for joining me. Now remember this live stream and my answers will be general advice, so it may not be appropriate for you, please bear that in mind. And if you've got any questions as we're going along, please feel free to pop them in to the comment section on Facebook and I'll get to them before I finish. Well, it's a huge week, there's lots going on. We had the Fed last night coming out with this decision. The markets went up quite a lot. US dollar fell. So the Australian dollar went up. So there's a bit going on there. We've got the Royal Commission final report going to the government tomorrow. And it's going to be available to the public on Monday. There's a lockup, which I won't be in, but it'll be publicly available at 4:10 on Monday afternoon. So I'll start reading it then and write in the morning. What else? CPI yesterday. So much going on. It's incredible. And we've got lots of questions, I'm happy to say. So thanks for that and looking forward to getting into them. Great questions, as always. Now, one of the things that went on, of course, is that I got a gong last weekend, an AM, which was great. And the first few questions in my little screen here are from people that aren't asking questions, they're just saying congratulations. So thanks very much for that, Jonathan, Judith and Sandra. I appreciate your sentiments and yes, I'm chuffed to bits about it. Never thought I'd get a gong. Certainly the first member of my family to get one, that's for sure. Probably, well, I'm just trying to think, possibly it's the first person at my school. Anyway, it's great and I really feel honoured to get it. So the first actual question is from Roger, and he says, the concern amongst self-funded retirees is understandable. I, for one, will lose a significant part of our income. However, correct me if I'm wrong, if companies no longer have to pay franking credits to shareholders, won't that money be available for investment? If I'm right, then we will have a greater capital gain as those investments pay off. Well, I'm afraid I do have to correct you, Roger, you are wrong. The thing about what's going on with the Labor Party policy is what, of course, you're talking about. The Labor Party policy is to not have cash refunds as a part of the franking credits regime. But companies still will be engaged in dividend imputation. That is to say, the dividends will be franked for those companies that are paying full tax. So a company that pays 30% tax will have its dividends 100% franked, and that will benefit people who are taxpayers who are paying 30% tax or more. That is to say, those who are earning $37,000 or more and are therefore in that higher tax bracket, you will get the benefit of the franking. But what you won't get if the Labor Party wins the election is that if you are paying less tax or no tax, you won't get a cash refund, which is what happens at the moment. So self-funded retirees in pension phase over 60 SMSFs currently get paying no tax, and therefore they get the franking credit as a cash refund. So what's going to happen is the Labor Party is going to knock that off. There'll be no cash refunds, and so that's really what's happening. The money will not be retained by companies. They will not have more money to reinvest. The only thing that happens is the government has more money to reinvest because they won't be paying out quite as much, or at least they won't be. They won't be paying out money in cash refunds for those people. So I can't remember how much it's going to save them, but it saves the government quite a lot of money, and that's what it's all about. Labor Party is trying to create a war chest for election promises, which is why it's doing that. The abolishing cash refunds on dividend franking, it's halving the capital gains tax discount, and it's focusing negative gearing on new houses only. And those three measures on taxation will, I think the figure is like $5 billion, which is going to save, and that's going to be spent on handouts to other people. So the question really for the Labor Party is whether the votes it loses as a result of those measures, in particular the dividend franking measure, the votes that it loses will they be less than the votes that they gain with the cash handouts from the money. And I reckon it's probably touch and go, to be honest. I reckon that they're going to lose a lot of votes from the dividend franking thing in particular. So I think, it's a problem. But it looks like a bit like they're stuck now. They might try to cap it or make some change between now and the election to try to soften the blow and not lose quite as many votes, but we'll see how that goes. Chris says, I have both SMSF and MLC Super and was looking at Vanguard's wholesale funds. These seem to offer a similar product to MLC but with lower fees, albeit with a 500k minimum investment. What do you think of these funds? Are these accessible to SMSF investors? Can you get someone on to tell us how wholesale funds work? I can get someone on, but I did ring them this morning. I rang my mate at Vanguard this morning, and look, he says wholesale funds are only available to wholesale investors, so you have to go through the process of showing that you're a sophisticated investor. It's not too hard. I mean, I think it's $250,000 income, and there's a certain amount of money in wealth that you have to have before you're regarded as a sophisticated investor, and then you can invest in the wholesale funds if you want. But this bloke at Vanguard said really there's no difference between the wholesale fund and the Vanguard ETFs. And so if you're interested in those funds, just go in the ETFs. The fee is the same and the portfolio is the same. It's all the same, but the minimum investment is much lower. It's whatever you like. And it's the fee is the same. I think it's 15 basis points. You can't get any lower fees than that. Oh, actually can. Now here's the thing. The first thing, Chris, I should say is you really probably should consolidate your super into the SMSF or MLC if you want to, but their fees are too high. So don't, just get rid of MLC super really. Move it into the SMSF. So you've only got one. You're only paying one set of fees, and I do think you should look at the InvestSmart funds. Now they've got a series of, if you look on the InvestSmart website, you'll see a series of ETF funds where the fees are capped at $451. Now one of the reasons I came here was happy to sell Constant Investor to InvestSmart and to join the place as the editor-in-chief is because they're capping their fees. And it means, look at it this way, if you've got $500,000 and you put it into the Vanguard ETF, you're paying 15 basis points, which is $750. The InvestSmart ETF funds are capped at $451. So look, there's not a lot of difference, it's true, $300 difference, but the real difference is that a percentage fee, whatever the percentage, even if it's 15 basis points, compounds over time. It compounds with the return, whereas a capped fee doesn't compound. And I think that's a really important and beneficial difference. And we're just talking ETF funds here. It's not as if, it's not as if we're talking a question of whether the InvestSmart fund managers are better or worse than anyone else. It's really to do with ETF funds. Fees are capped at $451. I mean, obviously you have to have more than about $100,000 in them to make it worthwhile. I think the up to $87,000 the fee is 0.55%, so it's it's a reasonably high percentage. But if you're investing a significant amount of money, like $500,000, you've got to look at the capped fees at InvestSmart, no doubt about it. And if you think I'm saying that because I work here, well, of course I am. I think it's great, and I'm all in favour of it. But look, if you've got a small amount of money, like $50,000, then you probably are better off in a Vanguard ETF where the fee is only 15 basis points. So don't tell the boss I said that. Michael says, Alan, lithium stocks such as Galaxy and Pilbara have been sold down lately. Any idea what's behind it? Is it a buying opportunity? I'm not an expert on lithium, but I do note that the lithium price has been falling, fell for most of last year, and the forecasts, as I note from analysts, is that the lithium price will probably continue to fall this year. And so the reason that Galaxy and the other lithium stocks have been falling is because of concerns about their margins getting squeezed by the falling lithium price. As to whether it's a buying opportunity, probably will be eventually, but if it's true that the lithium price is going to keep falling this year, then the answer is not yet, I would say. You'd need to see how it settles down. The problem is with lithium is that there's so much material coming onto the market. Because everyone's excited about electric cars. There's mines sprouting up all over the place. So the lithium production is rising. There's a tremendous amount being brought on stream, and the price is being driven down by excess supply. And I think it'll probably take a little while to shake this out, but I'd be careful. I'd certainly be careful about this. I mean, there's no doubt about it. Lithium has a great future. We're just seeing Porsche and Audi and all these. I saw something this morning about Volkswagen planning to come out with its Tesla killer. They're all trying to come out with Tesla killers, these car companies. So look, within 12 months or 18 months, all the major car companies are going to have electric vehicles on the market, and I think that's when it's really going to start to take off, I would say, because you need a range. The problem with Tesla is there's just not much of a range. There's your Model S and your Model X, and that's it. Whereas suddenly, if all the cars come out, everyone's going to start looking at them. I think at some point demand will really start to take off, but not for a little while. It is the case that with these things, the share prices of these companies do tend to anticipate those changes. So, it'll be earlier than the bottom of the lithium price cycle that the share prices of these things start to move up, I imagine. But who knows when that is, I'm afraid. Anthony says, "Hi Alan, I'm interested to know why BAF's share price has been constantly under its NAV." Now BAF is the Blue Sky Alternative Access Fund, which is the listed investment company that goes with Blue Sky Alternative Investments. I own a few of these myself, so a declaration on that score. And yes, it has been constantly under its net asset value by 25% or so. So quite a lot, a big discount. Anthony says, would it be the case that the assets are overvalued or the market simply has zero faith in the company? I don't think the assets are overvalued. I would have sold myself if I thought that, but I don't think they are. I think the market has zero faith in the company, and it'll take a long time for that trust to be rebuilt, even though the whole thing is under new management. The managers of the BAF are different, so the old kind of untrustworthy managers are gone. As Dr. Phil McGraw says, it takes 1,000 attaboys to overcome one you idiot, and he's talking about bringing up children, which is to say that if you're mean and horrible to a child, it takes 1,000 pats on the back to overcome that. And I just think something similar applies to companies. It's really easy to destroy trust. Very hard, takes a long time to rebuild it, and that's what's going on here. So I think all of us investors in BAF have to be patient. It'll take a while, but I do think it'll get there. Gavin says, "Hi Alan, appreciate your thoughts on TLS, Telstra, after the news from TPG this week. Less competition and more growth outlook for TLS." Well, indeed, Telstra's share price jumped after TPG announced that it wasn't going ahead with its mobile network. That is true. So I then rang up my friends at the ACCC and said, what's going on? Because the question is whether the merger between TPG and Vodafone will be approved, in which case if it is, they won't build a fourth mobile network, and Telstra's share price elevation is justified in the sense that there won't be that extra competition. And because if the merger with Vodafone is knocked back, in order to get into a mobile business, TPG will have to build one, even though it's already now said that it's not going to go ahead because it can't use the Huawei equipment, which is pretty amazing in itself. But anyway, so what's happening is a few people wrote stories to the effect that David Teo of TPG was blackmailing the ACCC by saying that it's going to cancel, it's not going to go ahead with the fourth network to try to force the ACCC to approve the merger. And my mates at the ACCC say, well, actually, we don't think that's right. And what they're now deciding to do, or deciding, is whether to call Teo's bluff, because they might. In which case, if they do knock back the merger with Vodafone, then Teo's has a problem, because even though he's Australia's second largest fixed line telecommunications company, he can't really continue on without a mobile network. I think they have to have one. And if they can't get the Vodafone one, then they'll have to build one. So I think it's still, the bottom line, Gavin, is that it's still up in the air. It is not decided yet. And it's possible that the TPG will still go ahead with building a fourth mobile network because they won't be allowed to merge with Vodafone. So yeah, I mean, it's hard to, and what they're saying at the ACCC is they're not sure they're going to believe that the TPG will not build a fourth mobile network, partly because, I mean, if you read the announcement from TPG, they're saying that we are not going ahead with our mobile network because we want to use Huawei equipment, and we're not allowed to because the government has banned Huawei from supplying 5G equipment. That's the deal. That's the reason. But, you know, the proposition that Huawei is the only supplier of 5G equipment is ridiculous. Of course it's not. There's tons of suppliers, so they can easily get other stuff. Maybe it'll cost a bit more, not much more. So of course TPG would be able to build a mobile network without Huawei equipment. And it's possible that the ACCC will bet that they will do that if the merger with Vodafone is knocked back. Michael says, the transition to InvestSmart includes the Essentials package with a yearly subscription. Trying to obtain fundamentals about a company such as cash flow, etc., could possibly be a problem even at the higher professional level because there is no direct way to contact an advisor. I don't know what that means, Michael. The fundamentals about the company are there in the website. So my comment is, all it is a database. The stuff is there. You just have to go and get it. I don't really understand what you mean. So why don't you write in, Michael? Perhaps explain the question a bit more. I'll be happy to write back. Just write into the to the main email line on the website, and they'll pass it on to me, and I'll be happy to answer it if I can. Jamie says, hello Alan, thanks to your interview on PolyNovo back in 2017, I'm up about 45%, so thank you. You're welcome. Very happy about that. Was wondering when you next get a chance to have another interview. FYI, they've just purchased a larger building for expansion. Yeah, look, it's about time I spoke to them again. I hadn't even kept an eye on them. Wish I'd bought them. Bloody hell. I didn't buy them. Typical. I only buy stuff that goes down. Tim says, hi Alan, I'm trying to understand some history about Labor's proposed franking credit changes affecting retirees. I know that Howard Costello introduced the refunding of excess franking credits in 1999, I think. I also read somewhere that they also made pension streams tax-free from July 2007. Do you remember how pension streams were taxed prior to 2007? Yeah, they were taxed at 15%, and then the Howard government, Peter Costello, announced that pension streams for people older than 60 would be tax-free. And we've been trying to get rid of that ever since because it was a stupid thing to do because the budget couldn't afford it. I mean, that was July 2007. Pretty soon the world fell apart and government revenue collapsed, and it was a real problem. So, yeah, I don't know what else I can help you with, Tim. I'm not all that familiar with all these tax things, but yes, those things that you've got there are correct. You are right about some of that stuff, and the previous tax stream, as I understand it, was 15%. Inga says, where do you think Westpac shares are going in the short term? Really don't know, Inga. I'm afraid I'm not much of a forecaster of share prices going up and down. Westpac, it's on a yield. Its PE is at a slight discount to the other banks. Its yield is 7.5% roughly. So look, it looks like good value. I've been writing recently in the overview that banks are starting to come into value, certainly for income investors. I think it's unlikely that they'll cut their dividend. If they do cut it, it won't be very much. So I think there's reasonable value in a 7.5% fully franked dividend from Westpac and the other banks, 100% franked. So I don't think they're that expensive, but I do think they're going to struggle to do better. All the banks, Westpac included, they're going to struggle to do better than going sideways for a while, and that's because credit growth is slowing, the economy is slowing. Bad and doubtful debt provisions are probably only going to go up, not much. I mean, I don't think we're going to see some big blowout in defaults, but they won't go any lower. They'll only go up. For these banks, there's going to be nowhere to hide on a regulatory front. The government, particularly if it's a Labor government, following the Royal Commission, plus APRA, plus ASIC, they're all going to be all over them like a rash. I just think don't invest in any of these banks with an expectation of capital growth, because you probably won't get it, and you'll probably get a bit of capital loss. But the yield is okay, So it depends what you're investing for and what your time frame is. Short term, I never know. A short term anything could happen. Like you could get. You could get a blow up in China, or China collapses, or there's a trade war, or who knows what the hell happens, and the whole market goes down, and you've got no idea. So it's very difficult to predict these things, particularly for the short term. Dave says, hi Alan, I don't use Facebook, but watch your podcast with great enjoyment. Well, that's good. I've had some shares in my personal account over 10 years with huge capital gains, so not worth bringing into my SMSF. Under Labor's proposal, will the 50% reduction in CGT due on these shares be grandfathered, or will it reduce to 25% after the expected Labor victory? The 50% reduction in the capital gains tax discount to 25% will be grandfathered, but we don't know the date of it yet. The ALP's policy says they'll reduce the capital gains tax discount for assets that are held longer than 12 months after a yet-to-be-determined date after the next election. All investments made before this date will not be affected by this change and will be fully grandfathered. So, yes, it's grandfathered, but we don't know when from. But we do know it'll be after the next election. That's what they've said. It won't be before. So they won't go... Actually, it was all from January 1st, 2019, unless they were lying, which, these things, these are politicians after all. But no, I don't think so. I think what you're talking about is the date after the election. It could be the following day, who knows? But it'll definitely be after the next election. So anything you do now will be grandfathered. What's next? Jeff says, I've been following SSG since it was mentioned in a fund manager interview back in August. It seems like a really nice business, but the share price has been getting hammered. Is this the Amazon effect, or am I missing something else? SSG stands for Shaver Shop. And I think you are missing something, Jeff. Just go out in the street and look at how many beards there are. I mean, no one's shaving anymore. I am, because I've got to go on the TV. But I wouldn't be shaving if I didn't have to go on telly, I'd tell you. Or I wouldn't shave very often, that's for sure. So, my son doesn't shave. I look around the office here, they're all hirsute. So I reckon beards, clean shaven is going out. So, yes, there's the Amazon effect for sure, because, people are buying shavers online, but also people are growing beards. I'd say that's what's going on. I mean, I'm not an analyst of SSG, so I'm not saying I know that for sure, and I haven't even interviewed them for a while. Maybe I should. Hey, Greg, let's put them on the let's put them on the list, Greg, for an interview. I think that'd be a good interview. See if it really is a problem for them with everyone growing beards. Sandra says, "Hi, Alan. QRE, the resources ETF, has rallied well over the last few weeks. What are your thoughts on resources going forward? Is it a good time to buy BHP, or do you have other resources stocks you prefer?" Well, Sandra, no, I like BHP, but I do think really the thing to do, unless you've got a particular stock in mind, buy the ETF, buy QRE, which is the BetaShares ASX 200 resources, which is the index. The index symbol is XJR, so it's the ASX 200 resources, and it's if you buy QRE, you are buying BHP. I think it's about 28% of that index, BHP, and then you're also getting Rio, Newcrest, Woodside, Fortescue, Santos. So you're getting quite a good spread of resources stocks. So look, that's what I'd say. I mean, if InvestSmart had a resources ETF, ETF fund, I'd suggest doing that because it's lower fee. But I don't think they do. I'm still learning about InvestSmart. I've looked on their website. I can't see a resources ETF fund. So therefore, you probably, if you want to focus on resources, you'd need to do the QRE that BetaShares does. I don't think you should put all of your money into resources. In any case, I think, but I do think it should be a part of a portfolio. I think resources, as you say, resources have been rallying lately because the prices have been going up, and it's quite interesting why that is, and it's a bit of a mystery, to be honest, because in particular, I mean, our resources index, our resources sector is mostly about iron ore. Obviously, because BHP is a third of the index, and then there's Rio, which is another 10% or something. So almost half the resources index is iron ore. The iron ore price has been going up, even though the Chinese economy is softening, weakening. And normally, you'd find the iron ore price basically tracking the Chinese economy, but at the moment, it's not. Now, it's quite possible that you'll see a correction in the iron ore price this year, just coming back to what the Chinese economy is doing. So just bear that in mind as you're thinking through what to do and whether to invest in iron ore companies. I mean, the benefit of BHP and also therefore QRE is that you're getting a broad range of things. So you're getting Newcrest as well, which is gold, Woodside, which is gas, oil companies as well. So I do think the diversification is important because focusing on putting too much money into iron ore at the moment could be dangerous. It has been going up, as I say, but the Chinese economy doesn't look like it's going to turn around in a hurry. I'd say it's going to continue to soften, possibly quite a lot, and you could see further declines in the iron ore price. Peter says, "Hi Alan, more a comment than a question. I'm pleased more and more AFR and InvestSmart journalists are referring to tax on retirees rather than abolishing imputation credits. I would also encourage them to write that all Australians will be affected because all Australians either now or will in the future be retirees and will be subject to the proposed unfair policy. Journalists should encourage the public to consider that when they next vote. Okay. Consider the comment made. Colin says, Alan, which shares are likely to pay excess franked dividends ahead of change to government policy? Yeah, I've been asked this. There's no real data on which companies have excess franking credits. I'll have another look in the next couple of days, and if I can find anything, I'll do it in the overview on Saturday. But I haven't yet been able to find any data on that. I wish there was. Barry says, hi Alan, congratulations again on your award. Thank you. Some gurus say January is a good guide for markets performance for the balance of the year. Perhaps you can interview a few fund managers that can review which sectors have performed well in January and give their outlook for 2019. Yeah, okay. I think it's rubbish though, Barry, that it isn't true. I mean, I've gone back in the data and January, the performance in January does not really reflect what happens to the rest of the year. It's one of those myths that people kind of like to talk about in markets. Yeah. So it's not true. Dar says, hi Alan, you seem to have changed your opinion of ETFs since joining InvestSmart. Should we buy them now? Well, I'm worried about there being too many ETFs being bought. I think that I don't think I'm all that in favour of whole market ETFs. I've always said I like focused ETFs. It's a good way to get diversification. But I am being persuaded, I must say. You know, in my discussions in here in InvestSmart, I'm seeing the data on performance of ETFs versus active managers, and the truth is that active managers, on average, don't outperform ETFs. You know, the more I look at it, that is true. So what you have with ETFs is cheaper funds that, on average, do outperform the active fund managers. The thing is that there are active fund managers who do really well. One of them, I can't remember the name now, one of them produced a 30% return last year. Now, I mean, it is true that this is the problem, that's almost never repeated. You know, you get a fantastic return one year from an active manager, and next year they're down the drain. So look, I mean, and Bennelong Concentrated Equities is the case in point. I mean, I interviewed them this time. I interviewed Mark East, who runs Bennelong Concentrated Equities, this time last year, and they just finished 30% return in 2017. Last year they were nowhere. They went from rooster to feather duster. I can't remember what their return last year was, but in 2018 it was, but it was minus a lot. They underperformed the market. So look, I am starting to realise that the ETFs are not that terrible. And the other thing about ETFs at InvestSmart is that they're capping the fees. I keep saying this is such an important thing. To cap the fees, they don't compound. And I think that's fantastic. I really, really think it's great. You know, so if you've got a small amount of money, obviously $451 is, or 0.55% is a fair bit, but you know, it's great. Even at that rate, even if it's a small amount of money, the fee doesn't compound. Michael says, hi Alan, I was wondering if the Money Cafe podcast with you and James was returning in 2019. Many thanks. What an appropriate final question, Michael, because yes, and today's the day. We're going, I'm just now going to go to the cafe and see Kirby, who has been in Ireland, you know, as he does every year, visiting the family in Limerick. And where else has he been? Oh, he's been all over the place. He went to Cork, Limerick, all these very, very exotic joints in Ireland, and he went to London and so on. So we can have a chat about that. But there's so much to talk about today with James. There's so much to talk about. I haven't seen his list of topics yet, but I'm sure they're interesting. Now, remember, the live stream today was general advice, may not be appropriate for you, so please bear that in mind. Today's Talking Finance podcast, apart from we've got the Money Cafe today back for the first time, and Talking Finance, I've got a terrific interview with Bernard Keane, who is the political editor of Crikey, talking about all these conservative independents who are standing against sitting Liberal Party MPs, and in most cases ministers like Josh Frydenberg, Greg Hunt, Tony Abbott, in safe seats, which is really interesting phenomenon. Kyle Rudder's talking about the markets, Joe Masters on the economy, and we've got a bit of a preview of the Royal Commission report coming to the government tomorrow. So, and we're also going to talk about that in the Money Cafe. So thanks for your company. Been great seeing you again. Talk to you next week.